Charles. Jim joining me today, as always, is my co-host Ryan. Ryan, how are things today?
Today is a good day. Another conversation, and of course, we got Eric joining us today. And I think the best way to kind of talk about today is it's almost like a dating service where you want to follow up on what all the red flags are that are going on in your world. And of course, we're going to try to tackle the red flags within your financial world. So here's a red flag. So
I love I love that. And we're not referring to Eric as a red flag. Eric is co-hosting today as well with us as a special guest. Yeah. So Eric, welcome to the show. How are you doing today?
Thank you. I'm doing great. Especially not as a red flag. That's the best kind of day.
Yeah, and for anyone who watched our episode last week where we introduced you to the TVH financial team, technology upgrades all of a sudden, like your camera's coming through beautifully and you're sounding, like just professional. So yeah, we're excited.
It always takes a little bit of work in the kinks out to get it figured out straight. But yeah, here we are.
Yeah, you're right. So today we are going to talk about, like Ryan said, red flags and fine print. We're going to talk about the OSC or OSCs, or Ontario Securities Commission, their mutual fund probe into banks selling practices or culture. And I know that we've had this conversation before in the past, right, Ryan? You and I, from time to time. And I know one of the things before we went live today, you said, we probably should be careful. We don't want to keep sounding like we're bashing the banks. And I agree with you. But this article, or this is actually different than other conversations that we've had, because before, whenever we've talked about the banks and their sales culture and their practices, it's always been from a news outlet reporting on it, clients maybe having some bad experiences. But this is actually based on a survey that the Ontario Securities Commission had sent out along with CIRO, which is the Canadian Investment Regulatory Organization. And they actually surveyed 3,000 mutual fund advisors who currently work at the big five banks. Mm-hmm. So this is actually coming from the people that are working and selling these products. And we found it quite interesting what the results are, and we wanted to share it with everyone. And I think I do want to say this isn't us bashing anyone. This is just the reality of the industry. This is what's happened. We want to share that information with you. And hopefully there's going to be some changes, because I think changes are needed. But before we do that, what I'm going to do is I'm going to start off with, and I hope technology works, a small video clip that it's a news story. So to kind of set us up for this conversation. So I'm going to go live and share this with you now.
Canada's top financial regulators are concerned that sales pressure inside banks is leading to some questionable investment advice. A new report by the Ontario Securities Commission and the Canadian Investment Regulatory Organization is shining a spotlight on the sales culture at 5 of Canada's biggest bank-owned mutual fund dealers. The report surveyed nearly 2,900 mutual fund representatives working in bank branches with a focus on 4 key areas, including the sales environment. This includes compensation, incentives, and scorecards, the sales pressure felt by reps, the range of mutual funds they can offer, and the overall knowledge and training provided. And the key findings of the report: 25% of representatives across banks reported that clients are sometimes recommended products that are not in their best interest. 1 in 3 reported clients being given incorrect information, and 40% said the internal sales targets or scorecards influence advice.
So we believe a lot of these concerns are rooted in the sales culture and sales environment that these reps are operating in, some of the incentivization, and also ultimately this performance tracking, which all might be contributing to these concerns.
Randava adds, this is just the first phase of a broader review, and they're still in a very cooperative process with the banks. So what's next?
Our second phase of work is going to actually dig a little bit deeper, and it's going to involve particularly the scorecards.
And how do you know if your financial advisor has your best interests at heart? Well, we asked an expert who tells us it's all about asking the right questions.
Do you have a fiduciary duty to act in my best interest? That's one of the most important questions you could ask. What are their credentials? In addition to their credentials are you acting in that fiduciary capacity even though you have those credentials?
Now, we've reached out to the 5 major banks mentioned in the report. While none provided a statement, they directed us to the Canadian Bankers Association for comment. The Canadian Bankers Association says it's currently reviewing the report while also releasing a statement. It reads in part that their members have always prioritized needs-based service, and they add that Canada's banks will continue to invest and collaborate with regulators. In Toronto, Jasmine Graywall, City News.
So, quite interesting. So I'd like to thank City News for that clip there. Any thoughts, guys, on what you've seen so far?
I guess having been in the business as long as I've had, listening to your stories, Jim, too, like it's none of this is new for me. And having been on a side where there were sales targets could kind of meet, but kind of loosely met. Again, I didn't work for a bank, but I've worked within kind of the sales world and retail because it's called retail banking for a reason. None of this surprises me. And, as our big banks are reporting some of the best sales years ever throughout all of this, I think it's a great first step to figure out what is in the best interest. And, speaking as an independent advisor, I get the opportunity to actually find what's best interest of the clients that I work with, because I'm not tied to one individual bank solution. I'm not tied to one individual insurance solution. And I think that's one of the things that a lot of clients don't realize. And I often say in our first couple of meetings, especially how am I compensated? Where am I compensated from? And I say straight up, I'm not chasing a sales target, so there is no extra bonus put towards me. And I think one of the big things is, I'm not a salaried employee, and when it comes down to it, if I'm not providing what's in the best interest of the client, if they're not enjoying the experience and the relationship I'm creating for them and helping them plan and achieve their goals, then they very easily can walk away. And for some institutions, they are salaried. And I'm not going to say it doesn't matter, but it's often the impression. And some of these employees are speaking out to the pressures of scorecards, the pressures of not necessarily having the best interest because they're trying to push a certain mutual fund or product towards a client that is not the best outcome. So none of it shocks me. I think my own experiences of going into banks and talking is this the best and only option that I have, especially as an advisor now, right? And being able to call out and ask deeper questions that most people wouldn't ask. And I love in the video it just talked about asking those questions of your advisor, especially at a bank level. So.
Yeah, and before we start getting into the stats and the results here, Eric, anything to add to that?
Yeah, well, I think one of the biggest challenges the banks have is the size. It gets really hard when, as an independent, we take for granted that if we don't like a certain solution, we can go find another one. And in the bank, they have this huge infrastructure that's there to kind of help the advisors do what they do. But in turn, it's servicing, I don't know how many thousands of advisors they'd have across Canada. But as soon as you start to get into a situation like that, it just becomes so restrictive. I would feel terribly restricted with what the bank would give me as a tool to work with. So there's step one where your hands are kind of tied as a big advisor at a big financial institution. But the second is, they're trying to remain profitable across such a broad group of advisors that, again, they can't just hand them every option on the table. Otherwise, there's too many to go. So I think that the bank system is almost at a disadvantage inherently because it just has that deep systemic problem. And then in turn, these things end up being disconnected from the customer. And so all of a sudden now, their system isn't necessarily there to do what's right for the customer. It's got a lot of bigger problems it also has to grapple with. And that's one of the things I've always loved about being independent. If I have something that doesn't serve my customer anymore or my client, I just go find the next thing. And for a bank to pivot like that, it just would be, they have thousands of people they have to train. They have systems that would then have to be adapted. So, giving them a little bit of the benefit of the doubt, they just have this massive machine that has to kind of be geared towards everybody. And I think in turn, it creates a lot of opportunity for advice that isn't the best option for a client. And so, yeah, it's a challenging environment, I think, to be in. At the same time, if it doesn't help the client, then why is it being done? I think is the good question to ask.
Yeah, I agree. I think what I find most fascinating about the survey, because this is something we've been talking about for years, like well over 20 years, complaining about the culture and the sales practices and people feeling like they're safe going to the bank and working with the bank and the banker, and that the banker was doing everything in their best interest. But the banks have denied the sales culture aspect. They've denied a lot of these points. And now their own employees are coming out saying, no, this is true. This is how we work. These are the recommendations we're making. And yes, they might be on salary, to your point, Ryan, but there are a lot of targets, right? And those targets, if you don't meet those targets, and I can say it as a former banker, I've experienced it myself personally. If you don't meet those targets, in some cases, you're not getting a bonus at the end of the year. So there are bonuses involved. You're not progressing in your career if you're not meeting those targets, right? You're kind of stuck. In some cases, when I first started with, and I'm not going to name the bank that I worked at, you would get fired. Like it was that cutthroat, right? So I'm just fascinated now that this is actually the people within the bank are coming out saying everything that we thought, that we heard all these years that we've been reported on is actually true, right? So the first one I'm going to talk about is how 25%, and this was an anonymous survey as well. I want to point that out. And if you want a copy to the survey itself with the results, let us know. We'd be more than happy to send that out to you. But 25% of the employees that were surveyed anonymously admitted to recommending products or services that may not be in the client's best interest, at least sometimes. And I know where I've seen this a lot of times is the sale of mutual funds to a client that clearly, when we sit down with them, should never be in mutual funds, either from a risk profile point of view, from a time horizon point of view, even from an estate planning point of view, right? So I'm going to speak as the former banker. Ryan, you haven't worked at the banks, right? And Eric, I don't think you've worked for a bank yourself either, correct?
No.
Okay. So yeah, so a lot of what I can share is based on my own personal experience and working at the banks. But like, how do you feel about that? 25% have actually come out and admitted that they have made recommendations that are not in the best interest of the client.
I'd like to see a deep dive, as the gentleman alluded to, digging deeper into the sometimes or always. That would be even more worrisome for what percentage are always recommending things that they know that aren't in the best interest of the client. And again, Eric, you mentioned that, and it's something always to take in consideration, which is there are so many different products to choose from for a client perspective, and how much, overwhelming can be on the advisor side that there is so much choice for a client that for an institution like a bank to simplify it for the people that are at the bank level that are making these recommendations is, here are the 3 options this month. Make sure we hit a certain target. So, and again, coming from a retail perspective, having worked retail for quite some time, there can be some hefty kind of lashback on not meeting certain sales targets along the way. So, it's not surprising to see the numbers, as I've said. It will be very interesting to see what the follow-up says with some of these when they dig deeper into the numbers and understanding. So,
yeah, it would be terrible as an advisor to be stuck in a situation where you saw someone who didn't need what you had to give them, and you had to find a way to make that fit. Yeah, I mean, at the same time, you can't excuse that. That's both a systemic and an individual challenge that they have to go through. But you're in a position where you're trying to help people, and you don't have the right tools. Again, as they say, when you have a hammer, everything looks like a nail. It doesn't necessarily mean that you treat it all the same, but if you just don't have the right tools to do the job, it would be a horrible place to be in as an advisor.
Eric, it's the reason why I left banking. I honestly believed that my career would be as a banker. I wanted to get into the executive level, and that was my long-term career goal. But I found myself too many times sitting with a client or a couple. And one of the things, like when I first started the bank, we were definitely a service model. That's what the banks were. And then they transitioned to a sales model starting in the early 90s. And we were basically told that we needed to wrap products around a client. They needed to have 3 or more products with our bank. And the reason for it was because they found that 82% of those clients would just stick with the bank. They just wouldn't move anywhere else because it was too much of a pain to do so, right? So a lot of times I would sit down with a couple, and I would make my recommendations, and it could be, mortgage recommendation and loan, line of credit, credit card, investment, whatever else. And when I first started in the banking industry, I just focused on the products that we offered through my institution. That's all I really needed to know. And then when you start to talk to your friends and other people, and you start to hear about other products offered through other institutions, you become curious and you start to research a little bit more. And it became increasingly more difficult for me to sit down and recommend products to clients, knowing full well that the product that I had to offer, maybe one of them was a good product, but the other 2 or 3 that I had to offer or recommend were inferior to the competitor across the street. But I can never say to the client, you know what, you should go and get those other 2 products over at the green machine or the blue machine or whatever else. We weren't allowed to do that. So a lot of times I would make those recommendations, and there was guilt because I knew they could have gotten something better somewhere else. But I had to work within the tools that I had in my toolbox with that institution. And if I didn't offer those products as part of the process, I was out of a job and I had bills to pay. Right. So even before we continue on, like, I'm not sitting here, and none of us are sitting here saying that the banker who's client facing should receive the blame for any of this. It is from up top. It's the pressure that comes from senior management and the executive level, head office, because they're just driving profitability. That's all they want, and they're putting that pressure down on the banker who's, again, looking to make a mortgage payment and feed their families and whatever else. Does it excuse them? No. Is it understandable? It is understandable. We just want to share with people that when you go to the bank thinking that you're going to get the best advice possible, we're finding out now that in a lot of cases you're not, right?
Yeah.
So let me just see here. 40%. So 40% of the respondents said that the scorecards used to track sales targets and activity influence their product recommendation. That's horrible, right? So basically it's, here are your targets. You have to meet those targets. The advisor is sitting there saying, I'm a little shy on this target. I'm going to recommend this product, not because it's in the best interest of the client, but it's because it'll help that individual achieve their own sales targets. Can you imagine if we did that in our industry? With the compliance and like we would be unlicensed. Like that's the thing, is we would lose our licenses. We would be severely penalized for doing some of these things.
Yeah, that's actually one of the things I really respect about Raintree and their theos around this is like it used to be that when I would sell a fund, you could either get one that had a higher upfront commission and no trailer, or a lower upfront commission and a decent trailer. And they've now said, you know what, there's no situation where it makes more sense for an advisor to sell the upfront commission as opposed to the trailing commission, because the trailing commission more aligns you with the client. You know, and if you're going to rely on your trailer as your earnings and you put them in something they shouldn't be in that's too high risk and it crashes, well, then that affects your commission. And so anything you can do to align the advisor with the success of the client is a significant step forward. And again, that's the problem, I think, going back to what Ryan said about the salaried advisors is, you know, they get paid whether the clients do good or bad. How do you incentivize the decision making that the advisor makes to be more and more in line with the client? And I mean, they'll never be perfectly aligned. I'm not sure how you would go about making it perfect, but there's a lot of things you can do. Like scorecards are, I think, a good example of what not to do, that just aligns them in a way that that has nothing to do with the customer, has nothing to do with their success, has nothing to do with their long-term goals being reached. So, I mean, those kinds of things just need to be, in my opinion, removed altogether. Without it being creating some kind of positive alignment. It just needs to be tossed in my opinion.
I was going to say maybe is part of their development of their scorecard is what is the outcome of each client achieving their goal, short term and long term, right? And that then displays, because
but it's not goal driven though, Ryan. It's not goal driven with the banks. It's product driven. It's transaction driven. That's the problem, right?
Well,
like
if
we
one of the
talk
people
about
on
goals
the
with our clients.
Yeah. Well, I was just going to say,
we talk about that, but
if one of the people on the OSC is listening to this podcast, hopefully they are, here's a way to help make sure that it's no longer meeting a bottom dollar line, but instead thinking about the client first and foremost. And again, working in a retail environment, NPS scores is a big thing. You know, net promoter scores, making sure that the service that you're providing is truly helping them meet a goal. So
I think it's going to be tough to do, though, because, I mean, the client may walk away feeling like they received awesome service. I don't think that still paints the true picture, because here's the thing. If a client comes in and says, my goal is to qualify for this mortgage, how do you measure that when then that advisor, part of their job is, well, now you have to cross-sell the mutual fund, now you have to cross-sell the credit card, now you have to cross-sell the line of credit, right? So I think that's the biggest challenge that the banks are going to have. And going to that point, I don't know how many times throughout the years that John and I would work with a couple who had been in financial jeopardy. We worked through a refinance plan, free up, a couple of $1,000s a month of cash flow, eliminate all the credit cards because that's how they got themselves in trouble. We feel good about it. And then what happens is they're calling back 3 years later in the same amount of trouble. Why? Because when they went to the bank to sign the mortgage documents, even though John had brokered the deal, what did the banker do? Hey, you qualify for a $25,000 credit card. Even though they just cut them all up because they got themselves in trouble, the banker doesn't care. They've got sales targets, right? And they would just repeat the problem. So I think it's just a different world between going to the bank and what the client is looking for compared to what we're offering, because I've had clients come to me looking for a plan and they would say, well, I went to my bank and they won't offer me a plan. They won't go through a financial plan with me or a retirement plan. It's not, they do say that they offer it. It is part of their offering, but I don't think a lot of the advisors really walk them through that process because it takes a lot of work because it's literally appointment after appointment. It's transactional, right?
A lot of times to access their
So
planning as well requires you to be in the higher the private wealth side, which isn't accessible to some of the
yeah,
people who need it the most.
yeah. Or they'll only incorporate the products that you have with that financial institution, and they won't incorporate other products you might have elsewhere, right?
Yeah.
Because the plan only connects to their own products that they have within their own financial institution. So it doesn't really give you the full picture, right?
Yeah.
And I think we need to address the elephant in the room, because there's probably people watching and listening saying, well, you guys are on commission. You know, like, how are you any different? Like, you're selling a product and you're being compensated for it, which is true. We're not salaried. We are in commission. What I will say is, when I first started, when I left the bank and I became an independent advisor, back then it really was if you offered one institution's product more than others. So if you had your own, there were some soft targets for advisors on commission. So if you did volume with them, you received higher compensation. So sometimes advisors would tend to recommend a specific insurance company or a mutual fund company because they were incented because of bonuses and higher compensation. That's really not the case anymore. It hasn't been for a very long time. So if I offer you an insurance product through 3 different insurance companies, doesn't matter who I place it with, the compensation is the same. Doesn't matter if I do more volume with one or the other, right? It's compensation is the same. It's no different on the segregated fund business, portfolio management or manager that we refer to. It's all very similar. So we no longer really make more money from recommending one institution over another when we make those recommendations, right? So I wanted to kind of clear that elephant in the room or deal with that.
Well, and in addition to
Eric, would
that,
you say
Jim,
something? Yeah.
I think it's important to note too that CRM2 or a more recent development is the disclosure of fees. And this is more in the investment side than the insurance side, although I think the insurance side has been pretty good at balancing the field. On the investment side now, we have to disclose all of our fees. If not everything, we're going to have to soon. And that was one of the practices I always enjoyed was letting people know exactly how I was getting paid on everything. And if the client saw these scorecards when they were being sold these products, I wonder how they would feel about that, because disclosure, I think, is the first step. If you know how your advisor is getting paid and why, then what they're getting paid becomes a little less important, because you know what underpinning incentives might exist. But I'm going to guess that the client never saw the scorecard in these cases.
You know what? I love that idea. Show the scorecard where you are on track for that month, sales wise, before the client signs the dotted line. Right?
Oh, interesting. You want me to buy this one that gets you a big bonus and you're almost there and I'll push you over the edge. How does this make sense for me?
Yeah. Yeah, exactly. Well, and listen, when I was at the bank, I remember I started off as a teller. Okay. And again, I was in the service side of things. And then eventually it transitioned to the sales model. So tellers, we had sales targets. We had sales targets and retention targets. And our sales targets were, you know, if we met with a client at the teller wicket and we saw a bunch of money sitting in their savings account, we would try to refer them to one of our personal banking officers, who would then try to move some, if not all of that money, to a mutual fund. And we would receive credit for that. And then, as I mentioned, I wanted the banking industry to be my career. So on a part-time basis, they saw that I was doing really well with the sales side as a teller. So they offered me a part-time position as a personal banking rep. And they gave me a target for the year. And within 3 months, I exceeded the target. So the branch manager brought me into his office and he said, hey, here was your annual target as a part-time salesperson at the bank. You've already beat that target in the first 3 months, so we're going to bump it up. And they bumped it up. And within 3 months of that, I beat the new sales target. And this happened every 3 months. And it reached the point where my sales target as a part-timer was higher than a full-time salesperson. And basically for me, it was, if I wanted to eventually get full-time, I had to achieve these targets. So it was the only way he was going to grant me full-time position in that branch. That was a lot of pressure. And looking back 30 plus years, did I recommend products that probably were not suitable for the client? I'm thinking I most likely must have, right? Not intentionally, but that was the game that we were in, that we had to play in. And I'm so glad that I'm so far removed from that, because now as independent advisors, when we make a recommendation, it literally is based on what is it that you need, and let's find the suitable solution that meets those needs amongst multiple financial institutions, right? We're not restricted to only working with one.
Mhm.
So
Yeah.
that's a bit of freedom that
I
we
think-
have, right?
I think one of the big changes too is when you're doing that. This isn't to expose your age or anything, but we went from like zero internet back then, or was it still horse and carriage at that point?
It was horse and carriage back then. It was dial-up.
So, and now we're in the information age, and it's kind of an incredible change. Over that 30 years, really, there was a massive change in how a lot of these products were delivered. And what it seems like is the banks really haven't been motivated to follow those changes. And like, you and I, we can talk to 10 different insurance companies when we're talking about one client and what fits them best. But we know that, the one bank who has their own insurance company is really only going to offer their own insurance. And so I think that's the big thing, is that, like, if you go back 30 years ago, I'm going to guess that there just wasn't a lot of opportunity for you to make bad investment recommendations to client, or not like there is today, where really, they have 2%, where back in the day when the big five banks, you're probably talking about, you had 20% of the products. Now the banks have a fraction compared to what's available. So it's just so much has changed. And it doesn't seem like they have an incentive. I mean, when your customers just line up to do business with you anyways, maybe that's what happens, is you just get comfortable.
Yeah, but it's all about cross-selling. It's all about increasing profits. Like that's really where it comes down from, right? That's the focus and the goal. And then as the bank employee, and you can't blame them for it, it's about being promoted and growing, and excelling in their career as well. So they're going to do whatever they can to meet those goals and targets, to make sure that they get promoted, because that's how you make more money. It's a small increase every single year, a little bit higher if you meet your targets, but really it's being promoted to another level. That's where the big increases would happen from a compensation point of view. So
the incentive is the growth.
It is. So 1 in 3, so a third of the representatives reported that clients have received incorrect information about recommended products or services. A third. Like, if we repeatedly provide incorrect information, we lose the client. The client would just fire us.
If I made 1 in 3 bad recommendations, I'd have to fire myself.
That's a very good point. Right?
Yeah.
But that's scary. And Ryan, you and I have seen it recently with clients again who come to us about having non-registered assets, and their banker recommends that they just name their kids as joint owners on the account, and that'll bypass the estate. And we know that that's really no longer the case anymore. It's not cut and dry like that. And not only that, it exposes those assets to marital breakdown situations, taxation, bankruptcy, right? But the banker's response is, just name your kid or children as joint owner on your account, and you should be able to avoid all this. That's just one example of misinformation, but I'm sure there's a lot more out there. Ryan, do you recall any others that you may have heard?
A lot of it is exactly what you just said, is just misinformation as to what they're being given. So that, again, somebody who came from the training and development side of things, my wonder is, like, what is the training and development that is being offered? How how are the representatives, the staff passing it? We're required to do X amount of credits per year to make sure that we're maintaining. I don't know what the banking industry is like. I can only speak to what I've had to do to ensure that I, keep my status as a, wealth advisor, insurance advisor, and making sure that I'm passing the knowledge of this information. And again, banks don't do the kind of long-term planning for most individuals. As Eric, you had said, maybe for people that are in the $1 million plus in assets, possibly, but for the most people that need it, they don't get daily planning that they do with us, right? Going through an actual client discovery, finding out where everything is, how at each step of whether it's reaching their goal, whether it's retirement, how each of these things affect it. So, our Monday meetings are important for me because when we're reflecting on or preparing for our week, it's the voice of others, because as we've said, you can't know everything within this industry, but you can sure as heck build a great team around to help support and making sure you're making the right decisions and giving clients the right information versus speaking out of turn and having people appoint, children as benefactors. Again, that's all. I'd be very interested to find out how 33, almost 34% of the employees there are getting their information to be able to share with clients that is misinformation, just as we continue to battle the TikTok videos and things like that. So,
well, you wonder if they're getting the employee is getting misinformation, or if they're intentionally providing misinformation to make them sound like they're better in terms of the solutions they're offering. I know on the mortgage side of things, there's a lot of misinformation that's spread out from the bank employee about working with a mortgage broker, as an example. That happens repeatedly. It's just clearly, blatantly wrong. When it comes to estate planning, we've talked about this in other episodes. The banker will recommend the joint ownership model, but they might know that there are segregated funds that are actually a better solution from an estate planning point of view and a guarantee point of view, but they just can't or won't make that recommendation, right? Because they're trying to meet their sales targets. It's clear cut, right? And it's clearly a cultural problem, is what it is, right? This is a culture now. This is something that we've been talking about for many, many, many years. And you would see an article or a newscast once every couple of years. The banks would come out and say, yeah, we're going to do better. We're going to, do the best that we possibly can to clean this up. We don't really think it's a big problem. And then it goes quiet and nothing changes. And then 2 or 3 years later, there's another one and another one, right? It just seems to be a problem that just will never get corrected.
At least that's been their pretty consistent track record.
That has been. Absolutely. Yeah. Now, with the sales culture, we're going to talk about the compensation structures that influence advice. I don't know what those are now today, but what I can say in my experience, as I mentioned, we had retention targets, and then we had targets based on the products that we offer, and it was a points system is what we had. So again, I don't remember from 35 years ago exactly what it was, but a retention target may give you like 0.5% per thousand or 50 basis points per thousand in terms of points. And if you open up a bank account, maybe it's slightly higher than that. And if it was a GIC, maybe it was slightly higher than that. The big bangs for your buck when it came to a referral was a mutual fund investment or a mortgage. And a line of credit. If we can get a client to open up a line of credit, even if they didn't utilize a line of credit, but we provided them with the largest. So, for example, I would refer a client to our banker. The client only had a $10,000 line of credit need, but they qualify for 60. And the banker's like, we're going to give you 60. And the clients would say, well, I don't need 60. I only want 10. But the 60 would be pushed through because the banker received credit on the 60, and there was a lot more credit on the 60 than there would have been on the 10. Right? When I worked at the call center for another institution, there were advisors. What would happen is there would be pre-approvals for clients, and we would, it was you press a button, you outbound the call, you speak with a client, you let them know who you are, and that they qualified for a $10,000 line of credit or $50,000 line of credit. If a client accepted it, you would click the button saying that they accepted it, kind of complete, and then you'd push it to the branch. And as the salesperson, we receive credit for that. If the client said no, then you press the button that they said no, and that was it. They would be off the queue. Well, I know of some advisors, because they were friends of mine, unfortunately, what they would do is if the client said, no, I'm not interested, they would click the accepted button, hang up the call, they receive the credit for the sale. Now it's the branch's problem. So then the branch would call the client saying, hey, we're waiting for you to come in to accept this line of credit. And the client's like, I don't know what you're talking about. I said no to it. But that never got back to the call center. Right?
Jeez, yeah.
So there were a lot of fake yeses or acceptances of these products that were pushed through with no recourse coming back to the actual agent who did it intentionally, even though the client said that they didn't want the product. Lots of examples like that, right? Not in the best interest of the client. It was always in the best interest of the individual. Does that mean every single banker that sits down with a client is like that? Absolutely not. Like there are good people who are trying to do the best that they possibly can. Again, within the system that they're working in. But it is easy to maybe cross that, get in the gray area with these situations when you have this level of pressure that's pushed down on you. Like, I'm just thinking about situations. Like, I remember there was a product launch. It was a horrible product that this one institution launched. It was the best of the best mutual funds, and they pooled it into a portfolio. And the way that they came up with the top 10 best mutual funds was they would wait to see what the prior year calendar year returns were. So if they had a great return the prior year, they would put that into the portfolio, and they would eliminate the ones that actually finished the year poorly. So essentially what the marketing team who created this product, what they were doing was they were selling low and buying high. So the fund didn't make any money, right? But yet we had sales targets and we had to push this product. And there was an X amount of money we had to raise for that product, even though as the advisors were sitting there going, this is horrible. Like, I wouldn't put my own money into this product, but yet we had to push it. We had no choice, right? Those are the situations that, unfortunately, those bank employees are being put in. So I'm glad that the bank employees now are coming out saying, this is true. This is what we're dealing with now, right?
Yeah, and going back to your conversation about being cultural, I do think, and the way you explain that situation, I do think some of it is systemic, in that it's such a disconnection between the people who are picking, what companies go into what funds they're offering, to the advisor who has to then put this in front of a client. When you have so many layers involved, I don't know how they can solve that problem. Like, when I sit down with a client, I can tell them about every company they're going to be investing in, what they're doing, what the managers' names are, or the CEO, and that, that I talked to them a few months ago. And to be a bank advisor who probably never talks to the portfolio managers, or maybe gets a presentation once a year from them at most, how do you fix a problem when there's just zero connection between the client and the person who's actually making the decisions on with their money or insurance or mortgage or whatever it is? That's a challenge I'm not sure they'll ever be able to find an adequate solution for. But they got deep pockets, so hopefully they can come up with something for the OSC.
I don't think they're going to, because the bottom line is it's not in their best interest as the bank, and it's too difficult. Yeah. It's like trying to steer the Titanic it's just very difficult to do, right? It's too big
with
of a
a
machine.
paddle.
Uh,
Yeah.
exactly, with the paddle itself. So that'll be a challenge. I look at our industry and specifically on the insurance side. When we engage with a client, the level of disclosure that we have to send them before
Yeah.
they actually transact with us, like I don't see that at the bank, right? Or no, I actually don't see that at the bank whenever I've done banking with them. And then when we make a recommendation, we have to outline through a reason why letter why we made the recommendations every
Yeah.
single time. I don't see a reason why letter from when I open up an account with the bank, a line of credit or whatever else. Like I don't see that, right? It's just here's what you bought and here's the terms of the agreement, and that's about it, right?
Yeah.
There's just so much more we have to do as independent advisors to make sure that we are clearly illustrating that the recommendation we're making is in the best interest of the client and not our best interest.
Well, and
Right.
I think that's
So maybe
another
they need to do a little more of that with the bank.
Yeah. And I think there's another distinction that should be made too, especially in insurance. When someone at the bank sells you insurance on your mortgage, most of the time that person is not insurance licensed. They're selling a group product that doesn't require the license.
Yeah.
And then when we answer someone's mortgage insurance question, we're doing it with an actual licensed product. So therein lies a disconnect. One group, us, is required to have almost a fiduciary responsibility or a responsibility to ensure and communicate to the client why this was the best solution. But when you're not, you can just say, okay, well, this is how much it is, sign on the line. It may not be the right answer for them, but there's no. So again, there's another disconnection between what's required in one system to what's required in another system. There's really just no comparison.
No, you're right. So Ryan, how can investors protect themselves? And this is not what we're recommending that people do. This is from the result of the survey. And if you're trying to figure it out, it's in number 4. But that is, if you want to go through some of that, how can they protect themselves?
Well, I was going to wing it, but I think all my answers are within the answers, which is obviously the things that we've talked about, asking about their fees and commissions. I would say straight up, show me your scorecard. And I think that would probably be one of the number one things, though, OSC could do is eliminate the bank's ability to even do a scorecard, right? I think that would be a big squash on it. Demand transparency. Again, I think we've all experienced this. The amount of transparency that we do for each step of the process with a client is pretty clear. And for us at least, speaking about me and you, Jim, especially, is this, we do wrap up reports for our clients and summaries and, the sales suitability first, followed by the reason why letter. All these about being transparent and making sure that the client understands every step of the process. And every client that's ever had a question has been very easy to be like, oh, everything was answered. And if in 2 years' time or in 5 years' time, that they come back and ask the question, why did I make this choice? We're making sure that we're documenting these things. So, and obviously, obviously the biggest one for me is, really for clients out there, really consider looking at an independent advisor. We have access to more than just one solution, and we're able to disclose all the fees that may be associated with those things, and making sure that, when we present to a client, here's one or two options, depending on which journey that client wants to take, as I'm waving my hands about, because it really is a path, and how we will pivot because a client's journey changes just like that, because they want to buy a home, or they buy a boat, or they have a baby, or a job change. we're very easily pivoting, and our commitment to our clients of really doing at minimum a 1 year. And I don't think I've ever had a bank reach out to me to say, hey, this is your yearly review. Let's sit down and chat about what's changed about your goals. If you have, please tell us who that bank is. But as an independent advisor, I set it in my calendar to make sure that I do a minimum of our annual check-in and reviews, see if anything is. And, we stay up to date. We were talking about this earlier. So how do we stay more in tuned with what's going on with the people that we work with? We want to celebrate their celebrations, whether it's a job change or something that happens, and how we can help support them and navigate and, again, rewrite and pivot on their financial plan that we've created together. So.
Yeah. And Eric, what red flags should clients watch out for in when they're conversing with an advisor?
Yeah, red flags. I think the biggest would be look to see what the breadth or the amount or what it is they're able to offer you. Ask them, are you limited? What is your basket that can solve this problem for me? Show me the basket of options you have. And these days, Google is your friend. Once you see that, you can kind of go and do some quick research on your own, or even ask AI, like if I'm dealing with RBC Bank, what other products that might exist that they don't offer, put some of that to work. And I think that's the biggest red flag is trying to see something that you don't normally see, or you might not have the education to see. And the depth of someone's products for a customer can be very difficult to ascertain. I mean, like any three of us could walk into a bank right now and say, oh, well, can you give me one of these, one of those? And we can narrow down what they can't offer in no time at all. But to someone who doesn't have that expertise, it becomes very difficult. And so it's very easy to just fall into, oh, well, if this is what they're offering, then this is probably what I should be doing. But in my mind, the red flag is you need to make sure that you understand what you don't know, and that's very hard to do. So the first question is, show me everything you have to offer, not just the ones that you are saying I should be in right now, and then tell me, well, why does this one make more sense than that one? So I think that would probably be the biggest red flag I would suggest people watch out for is try to wrap your head around what you don't know about what they're offering, because you can be led down a path without having any clue of whether it's right or not, without trying to open your mind to what other options could be there to make sure that what they're offering you is the right one, and ask them to explain that.
Yeah, I'm going to maybe share some specific examples just from my recollection of situations that I've dealt with clients. So if you walk into the bank and you say to the banker, I need this money in 3 months from now to buy a home. This is my $200,000 down payment. I want to keep it set aside. And they turn around and they say, we're going to put you in a mutual fund, an equity mutual fund. That's a red flag. Not a good idea, right? If you say to the banker, I have my RSP portfolio and I want to name my 3 minor children as the beneficiaries on my RSP, or my children in general, even though they are married, that's a red flag, because there's some major tax issues you're going to have to deal with that they don't talk about. If you say to the banker, my 92-year-old mother just sold her home and we want to invest it in something safe, and the banker says, we'll put your mother 100% into a bond mutual fund, that's a red flag. If you say to the banker, we want to try to avoid probate with this money, and the banker says, it's only 1.5%, not a big deal, don't worry about it, that's a red flag, right? So those are just some examples that I have dealt with when talking to clients where they've been given recommendations from the banker. If you say to the banker, here's another one, I'm going to need this money in about a year's time. I don't want to take a risk on this. What should I do? And they put you in a 1-year non-cashable GIC. That's a red flag, because you might need it in 12 months and it cashes out. But what if you need it in 8? You're in trouble. You can't get that money out, right? So those are just some examples. Ryan, you were saying that this is not going to be a long episode. We're approaching 55 minutes, so I think it's time that we maybe need to shut it down. Any final comments that you'd like to share with the listeners and the viewers?
Ask questions, and I think there's a lot to be said about independent advisors, that we are one, and that I would like to say most independent advisors would have a client's best interest, because we are referral based. We are trying to grow our knowledge and our business through making sure that people are happy with what we're able to create and help them reach their goals. And
we have a fiduciary obligation as well.
And most importantly, that also. So
yeah.
Very important that people understand that, which I don't think they realize. So,
yeah. Eric, how about yourself?
Yeah, again, it just comes down to sometimes it's hard to know what you don't know as a customer, and as Ryan said, get a second opinion, ask someone else, especially when you're dealing with an institution that kind of has a very fixed framework. Even if it's going to another bank, you'll get another point of view. But stepping back and going to someone who's independent, or finding a family member who has an advisor that you trust, there's a number of places you can go to really try to wrap your head around what you don't know. And I think that's the biggest challenge that customers have is because so many people will just trust the bank implicitly because that's the only place they know to go get financial advice. But don't be afraid to step outside of what you're used to doing and reach out to an independent. That's the nice thing about talking to us is, we can have a half-hour conversation and there's no requirement from the clients to really do anything except listen to what we say and make a decision on whether they think that will benefit them or not. And I think 9 times out of 10, you'll see your world will open up to you in that scenario, as opposed to being with an advisor that just has a very limited basket to helps to try to solve your problem. And again, do you want a carpenter that only has a hammer, or do you want to has a hammer and a saw and a chisel and I think that's the difference between that very fixed basket and someone who's got a tool bag that has all the tools they need.
Yeah,
absolutely.
I was going to add one.
Both of you.
I was going to say one other thing. Sorry to Eric. Is it's really tough to make a change, and I think it's really important for your own best interest to take the steps, question along the way, and making sure that the person has your best interests in mind. And I can't tell you more than anything is especially when it comes down to the compensation piece. If they're not willing to share that information with you, maybe it's not the right place, which is a huge red flag too. But yeah.
Awesome. Well, guys, another great episode. To anyone who's watching and listening, we encourage you to like, subscribe, share the content. We're on all the social media platforms. You can also sign up for our Money Mindset blog at tvhfinancial.ca. And you can find us at tvhfinancial.ca for any other information as well. Or you can use our email, financial@tvhgroup.ca, or give us a call at 647-727-4668. So thank you once again for watching and listening, guys. I think this is a great episode. A lot of information out there. And then finally, if you would like a copy of that report from Ciro, let us know, and we'd be more than happy to send that out. So until next time, have a wonderful evening. Take care.